where we have begun earning incredible returns on our consistently large cash holdings. So I have been honing the structured value stock purchase strategy for nearly 20 years. And since the inception of this fund, this has allowed us to build into our long-term compounders for below market prices, giving us world-class returns. One challenge is that as a result, we always have a lot of cash. The cash often sits idle for quarters and years, and it's held to purchase the intended stock when our short put contracts expire, but cash earns zero. And well, so we sit waiting for expiration with cash earning zero. I guess today you might be able to earn 2.6% in a treasury. So we earn this great premium by selling the put contract. But if we could obtain a sizable yield on our cash while we wait to buy the stock, we can perform far better. So for a decade, I have been looking for potential solutions for our cash problem. But until recently, it's always been earning nothing. In fact, 5 years ago in Switzerland, I spoke at the ValueX conference hosted by Guy Spear on some pair trade arbitrage opportunities that I had found for value funds while looking for higher yielding uses of our cash. And in the talk, I explained the challenges of implementing these in practice. Most of the opportunities were failing due to, in fact, they were all failing due to timing, due to liquidity, bid-ask spread, scaling issues. And I share this because it's important to recognize before we jump into this, that we have analyzed hundreds of possibilities that don't work to finally discover one that does. And the partners of this firm are going to make a fortune. We call this allocation structured dividend capture because we use structured products to capture high dividends in the market over a day or two and then immediately go back to cash. We treat this basket of small, we treat this as a basket of small positions, and we treat it as one holding inside of the portfolio, but it's really a cash alternative that's just providing enormous gains. So we start by collecting a premium, and pardon me, oh, sorry. I am experiencing there we are. So we start by collecting a premium. And it's right there on the top line. As we write an out of the money put for a good firm that expires days before a large dividend payment. We keep this premium and are possibly put the shares for as short as a week where we capture a large dividend. And then we exit that Friday collecting a premium on a covered call. So over about 15 days, we pick up a put premium, a stock dividend, and a call premium, and are left back in cash. In fact, we have a lot more cash than we started with. Further, we're doing this with dozens of securities at the same time. So any single holding may only account for 1% of the portfolio for a short period. So even if the share declines, it's not going to cause any significant harm or to the performance of the fund. Finally, our 13F analysis guides our decision to select these opportunities from a pool of 400 or 500 stocks that are held by the top fund managers in the world. One major challenge is that it required months of data analysis. How do we know each quarter when and where to allocate capital to capture the maximum yield? How can we maximize this approach? So we built software with Python to automate our analysis. This flow diagram illustrates the functionality of our software solution we built to aid our analysis. We have reduced the time required from many weeks each quarter to just a few hours. The software we built takes data in from 3 different subscriber databases. It creates our 13F superset of SEC data. It then breaks down financial metrics based on financial statement fundamentals so we can eliminate any firms with problems. And then the software recommends an ideal capital flow and Gantt chart that maximizes the IRR on our cash on an annualized basis. So let me provide you with some real examples from last quarter to help clarify. So once we've identified this capital flow, we start putting our cash to work. In this first example, we show results from the transactions around Lumen Technologies. The blue line indicates time moving from left to right. And we began by selling a $12 strike put on Lumen and receive an 89-cent dividend or an 8% premium, giving us a net cost for the shares of $11.11. We then hold the shares across the ex-dividend date on May 27th and receive 25 cents or 2.3%. Finally, we attempt to exit with a $12 strike call, but the stock price was under that strike on June 3rd, but it's not a problem. We just immediately sell a call expiring the following week. And with a strike of 11, we picked up another 85 cents at expiration. So this means on our net cost of $11.11, we earn a 25-cent dividend, a call premium of 21 cents, and 85 cents. And we also lost 11 cents between our price of $11.11 and what we sold it for, 11. So this is a real example. As markets were collapsing during 51 days, as the shares fell 2.7%, we made 2.8% for an annualized gain, 21.8%. In a similar example, here is Icon Enterprises. Here we have a $55 strike put, and we picked up $4.10 for our net cost of $50.90. And you can see we picked up an 8% premium on that put contract. We then received a 3.9% dividend of $2. And then we write a $50 strike call and exit for $2 and earn another 3.9%. Again, shares were just below 50, so we wrote a call for the next available expiration and earned a final $1.20, 2.4 additional percent from that call. But down at the bottom, you can see we adjust our strike price by $5 to exit the stock. And the stock declined 4%, yet we earned 8.5% over this time frame, which is a 27.4% compounded annualized return. Okay. Finally, I'm going to show you a loss because not every situation, our basket is expected to be positive. Hanesbrands fell 7.6% during our brief holding period. We received 3 payments, a put premium for 70 cents, a dividend of 15 cents, and a call premium for 40 cents. And our call strike price was below the put strike price because the price had fallen and we want to exit. So in this scenario, while the shares fell 7.6%, we experienced a decline of 1.9%. This, of course, is a very tiny holding, but because of the 3 incoming cash flows, they offset the full equity decline. Okay, how good can this get? Here is a forward-looking capital flow diagram that starts this upcoming September with an allocation to Devon Energy. It concludes with the allocation to Lumen. So take your screenshots now. This is what you receive when you start lining up the dividend dates and grabbing large dividends using structured value. So here we receive 21 premiums and dividend payments on these 7 securities over just a 3-month period. And this is about to happen. It's forward-looking. The potential exists to create a 34% gain on our cash in 3 months. It's phenomenal. In practice, we use a basket of multiple opportunities, but there's a really simplified version. A single track of capital can take. You don't need to every position here does not need to work perfectly to achieve outstanding results. So take a quick look. We'll walk through this here. We start the process selling a put on Devon Energy and earn 7.5% from the 3 incoming payments of the put premium, the dividend, the call premium. Then we move to US Bank, JP Morgan. By the time we've exited enterprise products, we will be up 23%. After Wells Fargo, Haynes Brands, and Lumen, you'll see down at the bottom right, we'll turn $1 million into $1.3 million in 3 months. So how could this exist? I mean, what and why does it exist? This is a strange anomaly. Most market participants are not using the products for these purposes. Puts are used to protect the portfolio, not to be capturing dividends. So these prices look correct to them. They just look wrong to us because we're using them for a different purpose. And we've estimated that we can push at least 30 million through this strategy because it's hard. It might be hard to get a lot higher because of volume constraints, but 30 million is nothing for a big bank or investment institution. So they can't do this. Not only are they totally unaware that the situation would exist, but earning 15% or even 50% on 30 million is totally immaterial for their earnings. And so they just leave the space alone. And further, retail investors typically lack the knowledge and capability to execute this effectively. Now, I'm sure some of you want to test this on your own, and you'll be successful. And I would be delighted to hear your stories. But this space is wide open, and we are just printing money. By the way, I want to point out this doesn't suggest that our fund size would be 30 million, because 80% of the capital is already allocated to the long-term compounders. We can operate a fund with hundreds of millions of dollars using just our idle cash to rip these premiums and dividends out of the market. So over this past summer, we began a very exciting collaboration with the computer science professor, Dr. Sid Krishnan, and his graduate student, Lavanya. We recently completed 25 years of backtesting, so we could examine results during periods like the Asian crisis, dot-com collapse, 9/11, financial crisis, pandemic, and the current inflationary and rising interest rate environment. And the results are astonishing. Since 1997, over a 25-year period, executing this strategy would have turned 1 million into $27 million. Compared to our benchmark, the gray line, the formidable S&P 500, that would have only grown to $10 million. So this provides us with a nearly 15% annualized return that is outperforming the gains in the S&P 500 by 50% a year. Impressively, we have 100 quarters of data, and the results there are only 4 quarters out of 100 with a small net loss. And we have just gotten started. With this back testing capability, we can now test minor adjustments over long periods of time, like consistently writing a slightly in the money contract versus an out of the money contract. One test we ran here on the top right is the results from a 13F output versus the global set of securities versus not using any options at all to buy and sell the stock. And the graph shows over the shorter period of 7 years where the 13Fs are starting to outperform the global securities. I do expect that they will outperform over time. The blue upward sloping line at the bottom shows results from grabbing dividends without using structured products as expected. And of course, we completely outperform that. I want to point out one last aspect that I forgot, which is if you look here without our back testing, the first 5 years on this chart, I think you'll notice it would be very hard for us to tell if we had a winning strategy. We wouldn't be confident because, for a while, the S&P, year 3, the S&P was still ahead of this particular strategy. But through back testing, we can see that the long-term nature of this is going to absolutely crush the market expectations. And that's exactly what we're testing with these new tests. So we can see that 13 Fs are starting to outperform the global securities. The blue upward sloping line, of course, is not even outperforming the S&P 500. And finally, on the bottom, I've illustrated our intentions of producing Monte Carlo simulations so we can look forward with statistical confidence, as well as looking backward. If we run millions of simulated paths through the model with price fluctuations that stress our variables, we can confidently create some expected returns and the standard deviations of that outcome. So let me reassure everyone, we are a long-term value-based fund with a concentrated portfolio of exceptional businesses run by extraordinary management teams that are selling for deep discounts. They're growing intrinsic value. None of that has changed at all. We also have used the structured value approach, selling puts as a tool to buy stock, since the inception of this fund. We have simply found a way to pull large amounts of profit out of the market while our cash is sitting idle because it's allocated to the future purchase of these compounders.